Good morning. It is Saturday, June 25th, 2022. It's morning in the United States, 11:34 a.m. on the East Coast. I want to get through a few news items, sort of macro comments, mostly from Twitter. We'll get into some charts and then we'll talk about the junior mining sector. That's sort of my agenda for today. So, um, last week was a big rally in stocks. Um, I made a video for Trading Labs subscribers Monday night. So Monday was a holiday in the U.S. for Juneteenth. Market was closed on Monday. The S&P futures were trading just over 3,700 at the time I made the video. And in the video, I said that I think we are in store for a rally. Sentiment is extremely depressed. 2 Fridays ago, triggered a lot of deeply oversold indicators, extreme fear indicators that typically, more often than not, with a pretty high probability, mean that we're in for a bounce. And that's what we got last week. Um, Friday was a huge rally. I'll talk more about that later. But um, this tweet is interesting to me because the market is now highly correlated with expectations for future Fed rate hikes. So the more the Fed has to hike, the worse it is for the stock market. The worse it is for all asset classes, essentially. Um, and for whatever reason, rate hike expectations moderated last week. So clearly, people are thinking that inflation is starting to moderate, the economy is beginning to weaken, and the Fed will have to do less in terms of tightening. And so that's being interpreted as bullish for stocks. And that's the simplest way to explain last week's stock market rally. There were a lot of other things going on, including the fact that we were really oversold heading into last week. We had the Russell rebalancing on Friday, which sort of adds some buying into the market. And we're getting into month end and quarter end next week, which generally adds a little bit of a lift, a little bit of a tailwind. So put it all together, and we had a very, very big move last week. So start with that. Mohammed Al-Arian sharing this thing from the Financial Times. Goodbye inflation. Invest in whiskey casks. Okay. So this is something that I've actually never seen before. Whiskey being pitched as an inflation hedge, as an investment. I mean, I know wine, but wine is honestly, investing in wine is even more treacherous than junior mining stocks, from what I've seen. You have to really know what you're doing. Um, so this is bizarre in my mind, and a sign of the times. People are looking during times of high inflation. People go far afield in terms of trying to find investments. In the 70s, people invested in oil wells, in race horses, all kinds of things. A lot of real estate investing happened in the 70s and early 80s. Um, yeah, it's stocks suddenly become way less attractive during times of high inflation, and people go to things like whiskey. So I prefer to see this as kind of a contrarian indicator that people are losing their minds over inflation, and that we're probably closer to peak inflation than the other way around, that this is a trend and you should invest in whiskey. Let's go to this. Okay. So this is interesting as well. Are we going to see the Fed cut rates in early 2023? I don't know the answer to that, but my sense is that the Fed is going to be done raising rates by the end of this year. And if we are seeing the Fed continue to raise rates into 2023, then oh boy, we're really in trouble. Next week, we'll get a bunch of economic data. Monday will be the durable goods. Most interesting, most likely, will be Fed speech at the ECB forum on Wednesday, and then the PCE and real personal spending and personal income on Thursday. This will be big. Thursday morning will be big. Okay, this data that will come out at 8:30 a.m. on Thursday morning will be big. Friday will be everybody will be off their desk by 10:30 a.m. and head home for the Independence Day weekend in the US. It's also Canada Day on Friday, so markets in Canada will be closed. So, the week will pretty much be over Friday morning. Everybody will go on a extended weekend. But this data on Thursday will be really important. And that'll be also month end and quarter end. So Thursday's a big day. And then most people will take a 4-day weekend. And look at the market estimates here. 0.5, pretty much for the PCE, core PCE. Credit Suisse is thinking 0.4, so a print that comes in light. I would expect the market to rally if it comes in at 0.4. And then, so I want to point this out because I posted this on, what was this, Wednesday? Yeah, it was Wednesday night, I believe. Yeah, it was Wednesday night. And the death cross in Freeport McMoran. So the death cross, just simply the 50-day crossing under the 200-day. What it really is just giving you confirmation that whatever market this is, the chart that's death crossing is in a downtrend. And it just so happens that FCX at Wednesday's close was deeply, deeply oversold in a downtrend, right? And so we ended up selling off further on Thursday. So deep capitulation. And we could look at a lot of charts of base metal stocks and oil stocks Thursday morning. Capitulation across the board. Deeply, deeply oversold. These stocks are deeply oversold, whether it's base metals or energy. A little bit of gold too. Gold stocks are less oversold than base metals and oil stocks. Depending upon which one you look at, of course. I'm not talking about Alexco or Rio 2 or anything, but generally speaking, I feel like we got a capitulation washout in commodity stocks and junior mining stocks at the end of last week. It felt like extreme pain. And we'll go into that a little bit more later. But I just wanted to point out that the last two times that Freeport had a death cross were March 2020 and October 2021. And just look at the chart. Here's March 2020 death cross right here. Look at what it did. Here's October 2021 death cross. It was not as steep a death cross, but still look what it did. Okay. So sample size of 2, but you could back test these death crosses in a lot of different stocks. And the backtest, results will show you that it's a tremendous buying opportunity, like 85% of the time. The problem is the other 10 to 15% of the time are situations like 2008 or early 2001 or something like that, where, the market went into a deep dive bear market and you could lose another 50%, right? So you have to take these signals into context and manage risk, but what I saw last week was some tremendous buying opportunities on Wednesday and Thursday across markets, across sectors. And we did get that deeply oversold bounce on Friday across the board, pretty much. Different sectors actually rose on Thursday as well, not oil or base metals generally, but they did rise a lot on Friday. And if you look at the SPY, right, so look at the S&P daily chart. This is really unusual that we have an island bottom pattern here. In fact, we kind of have like two islands. There's one island here, these two candlesticks that are isolated here. And then this whole grouping here is now an island because we gapped down into it and then we gapped out above it. This is one of the most unusual candlestick chart patterns on a major index I've ever seen in my life. So to point this out, I mean, okay, what does it mean? Well, it's an island bottom, which is important. It's meaningful for sure. I wouldn't take it lightly. I mean, this looks like an important low for sure. And you can see the daily RSI is just coming up to the median line. Let's see if it can get above it next week. The MACD is about to bull cross. There's a lot of positive technical signals starting to trigger here on the S&P. Meanwhile, most of the smart people that I listen to are in agreement that this is a bear market rally. And if the S&P gets up to, let's say, 4,000, so 400 on the SPY or 4,100, it's a short. And they're like, please, I hope it keeps going because I want to short it up there. Falling 50 days, kind of like a classic short setup. Short at the falling 50-day in a confirmed downtrend, right? That's like the bread and butter setup. The same way you'd buy a rising 50-day on a dip in a bull market, right? So the consensus is it's a bear market, short the rally. Okay, if we get a little higher next week, it's a short, right? They may be right. They may very well be right, but it's always concerning to me when the consensus is so obvious. It's so clear to everybody. Oh, it's a bear market rally. It can't last. I don't know the future, and actually, I want to preface the rest of this video that we should humble ourselves and be very clear that markets are unpredictable. Everything is a probability game in markets. There's no certainties. So anybody who's saying this is 100% a bear market, I know what the future is going to hold. I know this rally is going to fade, and we're going to crash under 3,000 on the S&P in the next few months. That's a lot of hubris. You don't know. And if we think back to March 2020, the amount of doom and gloom that was out there. I mean, just go back to the headlines in the market forecast. The pundits, were saying that, this is a bear market. This is 1929 all over again. And look what stocks did. And don't put a caveat on it. Well, but the Fed did this. There was a fiscal stimulus that nobody foresaw, blah, blah, blah. They always want to rationalize it. Just look at what happened. The future is unpredictable. So if we're talking about the stock market, financial markets, we're talking about trying to make money in investing and trading, just humble yourself. The future is unpredictable and completely unexpected things can happen. And they happen all the time. So while we might be clear on how we see things today, everything is in flux. It's constantly changing. The variables are changing. We have to change our model and our understanding of things as things evolve, as the world evolves, right? So the consensus is pretty much, 3 out of 4 people out there see this as a bear market rally. Most people are negative on the stock market here. They're negative on the economy. I'm negative on the economy. I'm less sure about being negative on the stock market, but I'm certainly not a raving bull here, right? But I'm also a market observer. So I observe myself, I observe others, and I see this consensus that's formed that we're definitely in a bear market. This rally can't last. that low over here, this island bottom, was not the ultimate low. That's the consensus everywhere I look. Meanwhile, let's look at insider activity. So insiders were not buying a whole lot of junior mining stocks. Listed in Canada. This is the INK, research site. I'm a subscriber. It's a useful tool. Not a whole lot of insider buying activity for much of the last year. In the last 2 months, the buying activity has ticked up appreciably. This is a significant uptick in insider buying. Insiders are becoming more bullish on their companies as the share prices have fallen. And pretty much just look at any sector, gold, diversified mining, specialty mining and metals, pretty big uptick in insider buying in the last couple of months, basically since the start of May. Now, is this an indicator that it's a bottom in the sector? Not necessarily. I mean, just generally speaking, company insiders tend to support their company share prices when the share price is falling. That's what they're supposed to do. They're supposed to bring in some confidence in other shareholders that they see value at these lower levels, right? But I think the amount of this uptick is quite notable. The amount of insiders that are writing checks, that are putting money to work here, is notable. And it's not a bearish thing. Okay, let's put it that way. It's not a bearish thing. Is it outright bullish? Is it a signal that the bottom is in? No, not necessarily. But let's tick that as a feather in the bull camp in metals, mining, junior mining. Talked about the S&P. Bond yield. So bond yield still very much in an uptrend. This is pretty, generally speaking, there is a negative correlation now between treasury yields and stock prices. So if treasury yields make new highs, that's going to be bearish for the stock market. If treasury yields moderate, if they start just consolidating here just above 3% in the 10-year and the 30-year, that would be generally a positive for the stock market and for equity valuations. Gold. So this is something we're going to talk about when I get to this list over here. But I just want to show this long-term 20-year gold chart. So there's a lot of hate on gold. Gold is not a very loved metal by most investors because it doesn't give them the returns, the juice that they want to see. I mean, most investors want to see 20 to 30% a year, and that's just not realistic in gold. If gold has an up 20% year, it's an extraordinary year. But granted, look at the last 20 years. It has had several plus 20% or more years. Gold is, despite all the hate mail, despite all the Fed rate hikes and tightening financial conditions, gold's at 1830. And if you look at historically, $1,830 an ounce gold is a very high gold price. It hasn't been up here very often. It spent a little time up around here 2011, 2012. Spent a little time up here in 2020. Obviously, it's been above this earlier this year, but generally speaking, this is a pretty good price for gold. And gold is very much in an uptrend longer term, as evidenced by rising 200-month moving average, rising 50-month moving average, et cetera, et cetera. So, and even, look at the monthly, relative strength index. It's consolidating above the median line. It's above 50, generally a bullish bull market sort of technical indicator. So yeah, I mean, gold is holding up very well. All things considered, gold is holding up very well. And technically speaking, it is still very much in a bull market. So while the S&P is technically in a bear market, having fallen more than 20% from its January all-time high. A lot of other asset classes are in confirmed bear markets right now. Gold is not one of them. So even though sentiment on gold is relatively moderated or even negative, the charts say otherwise. TSXV composite index. So this is kind of a proxy for the junior mining sector. It's not a perfect one because there's other sectors as part of this index, but it's good enough. And what is it showing? It's showing stocks at 2-year lows, lowest since June of 2020. We're in June 2022. Deeply oversold. Just look at this drop that we've had since March and look at the oversold momentum indicators. And also noticeable, if we look to the left, we're kind of just a hair above the pre-COVID early 2020 highs. So a reasonable spot on the chart to find some support. Okay. We talked about FCX. We can take a look at, so this is another one, tin miner, probably the biggest and best tin miner in the world. You can see what happened with this candlestick on Thursday. It got way oversold early in the session and then saw a tremendous amount of buying come in late in the session and close green, printed a bullish engulfing. Just another sign of capitulation in my mind, and the fact that people are even dumping the best just shows you how much pain is out there. Freeport. So the bull case is, well, we're way oversold here. I mean, look at this waterfall drop. I mean, it dropped from 43 to 29 in basically a straight line in less than 3 weeks, right? So we're deeply oversold. There's a bunch of gaps of overhead, right? Could easily see a bounce back to 34, 35 in Freeport over the next couple of weeks. Okay, reasonable bull case in the near term. So let's look at the bigger picture, weekly chart. So the bear case would be, well, look at how often this support around $30 a share has been tested in the last couple of years. And this kind of looks like a big fat top. And look at how far the share price is still up from 2020 levels. I mean, it's a double, a triple, a quadruple, depending upon the time frame that you're looking at, but it's still way up. And this is a copper miner. Yeah, they produce gold too, but copper is the main, metal for Freeport. And if we're entering a global downturn, a global economic downturn, copper's going to get hit even more, right? So this thing could drop. This thing could drop into the 20s. It could drop into the low 20s, right? And it's still up from 2020. So that's kind of the bear case. Is well, yeah, copper is still pretty high, and Freeport's still a cash cow. But what about 6 months from now? How are things going to look then? What is Freeport going to look like if copper drops back to $3? Right. So I'm just playing devil's advocate. I'm not trying to act like I know the future here. Remember, nobody does. We're just speaking in terms of probabilities. We're trying to think through different possibilities that could transpire as the economy evolves over the coming months and years. So now let's conclude this video by talking more specifically about junior mining, where the sector's at today. And I'm going to make a bear case to start off with. Very easy to make a bear case. So much fun to make a bear case. And then I'm going to make a bull case. And that is, well, it's not that much harder, but I think from a sentiment standpoint, people are much more comfortable with the bear case than they are with the bull case. The bear case is simply, well, I mean, we've had it good for a couple of years, and we know it's a cyclical sector. So we've had it good. Copper hit $5. Tin hit 40,000 plus a ton. Gold hit over 2,000. We had oil at almost 130 a few months ago. So all these commodities have reached really high levels in the last year or two. So we've had it good. And we know that commodities and resources are cyclical. So we must be heading into a downturn, right? We must. It's going to be a bear market. The sector has also performed horribly since early 2021. So junior mining stocks, so forget about the metals themselves. Junior mining stocks have performed horribly since the beginning of 2021. So a lot of people are soured on the sector and they're not coming back anytime soon. Also, the sector has brought it on themselves. I mean, these companies have performed horribly. The bad news never seems to end. Just look at the last month with Alexco shutting down their mill for 5 to 6 months. Rio 2, negative news last week. Stock dropped 50% in a single day. Then Ascot, Pure Gold, the list goes on. Disaster after disaster. The bad news never seems to end. People are just sick of it. Companies with zero revenues and earnings are the ones most likely to get hammered further during a recession and bear market in stocks. As you know, it costs money to run a company. It costs money to drill. It costs money just to have a CEO in an office. They're going to have to issue more shares. And if the market is bad, they're going to have to dilute at lower and lower valuations. If we enter a recession, then commodities are sure to fall further. And in turn, commodity producers will see their share prices smashed. We know that, just like looking at this Freeport run from 2020 low to the 2021 high and the recent high, that these stocks offer tremendous upside leverage during economic expansions and times of rising metal prices. But the sword cuts both ways during downturns. Money is no longer free, and the Fed is tightening financial conditions to bring down inflation. That's going to make it harder for companies to finance. And any marginal, so any company that's not of the highest quality is going to find financing is even harder than ever. Some companies are just not going to be able to finance at all. That's terrible for their share prices. Latin America, so South America, Central America, a very important destination for mining companies. A lot of metals in the ground, a lot of operating mines throughout Latin America. There's a decisive shift to the left in terms of politics. Latest example is Colombia electing Petro last weekend. Chile, just go down the list. Even Mexico has a leftist leader. It makes it harder to permit a mine. Are there any truly safe mining jurisdictions left? I mean, Canada is pretty much as leftist as it can get right now on the national level, with a huge history of mining. And mining is a tremendously important part of the Canadian economy. It's difficult to get a mine permit in Canada even today. If inflation becomes more deeply entrenched, so this is probably the worst case. If we're looking at 8% inflation still at the end of this year, that means the Fed and the ECB are going to have to tighten well past the neutral rate. So 3.5% or even 4% might not be the end. Well, let me tell you, if the Fed has to tighten, the Fed funds are above 4%, you do not want to be owning junior mining stocks. Such an over tightening could tremendously lower valuations across the sector and prices of commodities. Okay, are you depressed enough? So that's the bear case, and it's a pretty compelling bear case, quite frankly. And I think that the simplest, like I started this conversation about the bear case, is just that it's a cyclical sector. And we've had it good for a couple of years. So now it's time to have it bad for a couple of years. I think that's the simplest bear case, but obviously you can make it as complex as you want. Okay. Take a deep breath, clear your mind, close your eyes. And here we have the bull case. Okay. Valuations are depressed. TSXV composite is at the lowest level since June 2020. So it's a 2-year low. Sentiment, in my estimation, from what I observe, see every day, it's as bad as it was in mid-March 2020, if not worse. Why could it be worse than March 2020? Because of some of those specific company examples, just the terrible news that so many important junior miners have put out to the market in the last couple of months, which just like, I think that's the biggest punch to the gut. We know that these share prices go up and down. We know that the metal prices go up and down. We know sentiment swings wildly, but when companies are actually putting out significantly bad fundamental news for their individual company, it just makes it that much worse. So sentiment is really bad. Pretty simple that when sentiment is so negative, the upside opportunity is going to be the greatest, because your competition to buy those shares is virtually non-existent. Valuations are already very much depressed. They've been knocked down considerably in the last few months. Insider buying has picked up considerably in the last 2 months. We talked about that earlier. Again, that's a feather in the bullish camp. Did I mention that sentiment sucks? So this is something I can't stress enough. Last week, I received several text messages from friends and associates in the sector, investors in the sector, and they were capitulating. They just had enough, selling their stocks at the lows. Social media, it seems like every day on junior mining social media, it's a bar fight. It's a slugfest. Just really a lot of negativity out there. It's as bad as I've ever seen it. I'm not sure it's worse than late 2015, early 2016, but it's hard to gauge because we have more social media. We have more people talking today than we did then. So it's tough to gauge. From a valuation standpoint, it's probably not quite as bad as late 2015. I mean, that was really bad. That was really, really bad. And that was 2.5 years deep into a bear market, right? So, even like the worst outlook would say we're only like a year into a bear market here. So, yeah. But capitulation, there's a lot of evidence that it happened last week. Meanwhile, gold itself, as I said earlier, is in a strong bull market. While most other metals and asset classes are in confirmed bear markets, gold is holding strong. And actually, it's not difficult to make a pretty compelling bull case for gold right now, just with all the things that are happening in the world. Gold performs well in a stagflationary environment. Example, the late 1970s. Meanwhile, other metals like copper, the world is still facing a massive shortage over the coming years and decades, and there's no quick fix to that. The fact that Latin America is turning leftist and sort of anti-mining just makes the bull case for copper even stronger, because it's going to be that much harder to find new supply. Most higher quality juniors have financed this year and have enough cash to make it well into 2023. So there's no gun to their heads to do a financing here right now. And if they have to, they can cut their cash spend to survive. Now, obviously, that's not what investors really want to see, because then there's less news flow, there's less impactful data coming into the market. But if the choice is to spend the money and have to finance at multi-year lows or wait it out for better times ahead, I think waiting it out for better times is probably the smart move, But obviously nobody can foresee the future. In March, April 2020, a lot of people were hunkering down thinking that, they're going to have to make it through the next year with no new money. And then suddenly everything changed, right? So we don't know the future. And all we can do is try our best to guess right now. Finally, could the big declines we've seen in these stocks in the last few months have priced in a lot of the bad news and headwinds facing us? I mean, some of these declines in individual stocks, as we saw earlier, are significant and are indicative of much less optimism. So there's much less good news baked into these valuations now, such that if there is some good news that comes out after this deluge of negative news that we've had for a couple of months, these stocks could rally significantly. Yeah, so that's my best try at making a bear case and a bull case. And you can do the same yourself. You can, figure out which is more compelling for you. But I think it's safe to say that you're going to want to stick with quality. It's not going to be easy for the marginal or optionality plays or what have you to finance for a while, And just like I said earlier, look at these examples of relatively high quality junior mining companies that have just been smashed in terms of their share price and have not performed well on a company level in 2022. If the best guys can't tread water, then certainly the lower quality ones are going to be facing a lot of headwinds, right? So you want to really stick with quality. And the good news, though, is that even the highest quality companies in the junior mining sector have seen their share prices smash down. So there's no point in dumpster diving here. You might as well just buy the best because their share prices have dropped like the rest. So those are my thoughts on this Saturday. Have a great weekend, and I'll see you in the trading lab.